Hello everyone. Let me just check if the feed is proper or not. Can you hear me? Is the screen visible? Okay, I think it is all proper. So let's start. I'm Paritosh Panchal. Welcome to day 5 of the final revision. Okay, in day 1, we went through certain exam tips and tricks and an overview of the exam. And then in day 2, we discussed a topic, NPV and IRR. Day 3, we did certain type C sort of questions focusing on 3 major topics. Day 4, we did a mock. And day 5, that is today, we'll be doing the pre-June mock, which is not available anywhere. Okay, because what the institute has done is they have removed the June mock and have put in the latest mock, that is the September 2023 pre-mock. Okay, so I would request all of you to attempt that on your own. And today we'll be solving the pre-mock paper, June pre-mock paper for FM together. So without further ado, let's begin. I think it should be visible. Okay. Adrian is contemplating purchasing for $60,000 a machine which he will use to produce 10,000 discs per year for 5 years. These discs will be sold for $9 each. And unit variable costs are expected to be $5. Incremental fixed costs will be $14,000 per year for production costs and $5,000 per year for selling and admin costs. See, these are incremental fixed costs, so they are a relevant cash flow. If it was just regular fixed costs, okay, it won't be relevant. See, relevant cash flow is that cash flow which you will only incur if you do the project. So only if you are doing this project, that is, you are purchasing this machinery, only then are you going to have these additional fixed costs, incremental in nature. All right. So 14 for fixed costs and selling and admin is $5,000. Adrian has a discount rate of 10% per year. By how many units must the estimate of production and sales volume fall for the project to be regarded as not worthwhile? So if you remember, in sensitivity analysis, we find something known as the sensitivity margin, okay, which basically says that by how much can a particular cash flow or particular variable move such that the NPV becomes zero. Okay, and zero NPV projects we do not take, so they are not worthwhile. So we have to do that only if you have an understanding of sensitivity margin would you be able to correlate that, yes, I need to use that in this particular question. Okay, so let's start now. As discussed in day 1, it is recommended that you do all those solving questions towards the end, start with the theory, but for now we are going to do all of them as and when it comes. Okay, so ideally 50 minutes for section A. So let's start. So we have contemplating purchasing 60,000 machines. So we have an initial investment. Sorry, initial investment. Okay, of $60,000. Okay, now on your CB platform, getting the dollar sign may take a few clicks, but very easily you can get the numerical formatting. Okay, just with 1 or 2 clicks. So I request you to do that formatting. Reason being, you can understand very clearly whether you have added an extra zero or are short of a zero. So that's a better understanding. All right, wait, let me just put this a little lower so we can put in the headings. So these are all in dollar terms. So we have our initial investments. Then now the question is how many units? So units, if you wait, I'll just write the sensitivity analysis formula over here. So sensitivity margin is equal to the NPV divided by NPV of the relevant cash flow. All right. This is the formula. So we first need to find the NPV and then the NPV of the relevant cash flow. Those who are my students, we have studied that when it comes to volume affects two cash flows. One is sales and one is variable cost, because variable cost and sales both are a function of the units sold or volume. Therefore, contribution, when you combine the two, you get contribution. So contribution is the relevant cash flow. So we can just write contribution over here. So firstly, we are finding, so this is nothing but sales minus variable cost. Okay, let me just take all of this over here. All right, so sales minus variable cost is $9. Wait a minute. Is equal to $9. Sorry, wrong bracket. 9 minus 5. Okay, sorry, 9 minus 5 into how many units? 10,000 units sold. All right, so that's our contribution. And then we have our fixed cost. Fixed cost. So a fixed cost is how much? It's the summation of 14 and 5. 14,000 plus $5,000. So that's $19,000. Let me just format all of them. Okay. So we have done this. Now next is the annuity factor or the discounting factor. So let me just open up that, the formula sheet. Okay, so this is our formula sheet. From here, we need to find the annuity factor. And what's the discounting rate? The discounting rate is 10% for how many years? For 5 years. Okay, so in this case, initial investment is already in present value. So we'll write it as is. Okay. Contribution, it's a fixed cash flow. So it's an annuity. 10% 5 years. So 10% 5 years is 3.791. 3.791. And same thing will be for, same thing will be for fixed cost as well. So annuity factor, let me just explicitly write it. 10%, okay, at 5 years. Okay. Now just find the present value. We find the present value of all. So our NPV will be the summation of all of these. Okay. Actually, not the summation, because initial investment is an outflow. Then contribution is an inflow, so that will be added. And fixed cost is an outflow again. Sorry, wait. So that is why it's always a good idea to put the signs first. So this is an outflow. Wait, what I'll do is I'll just write the outflows as a negative sign over here, so you understand it better. Contribution is an inflow. Okay. This is an outflow. Okay. So now we can just add all of them. So 19,611 is the NPV. So sensitivity margin. Okay. Sensitivity margin of volume will be is equal to NPV divided by the PV of the relevant cash flow, which is our contribution. This is a percentage. Now, we don't want the answer in a percentage form. We want to know that by how much can our units fall. Okay. So this into number of units, that's 10,000 units. Okay. So 100. So 1293. So this will be our final answer. Just make this bold and highlight it. So 1293 over here. All right. So that's our final answer. Moving on, what is the effect on a UK based company when a foreign competitor's currency becomes weaker compared to sterling? The foreign company will be at a disadvantage in the UK market, or the foreign company will have an advantage in the UK market, or there is no effect. Well, it's definitely no effect. Okay. Let's try to understand what could it possibly be then. All right. If we say that, say, let's take an example. 2 euros is equal to £1. Okay. So our home currency is UK, and the counter currency is euros. Now, this turns into, they are saying that the competitor's currency is becoming weaker. So say the euro becomes weaker. That means the pound, our home currency, has strengthened. The counter currency has weakened. Okay, so for that very same pound, now you can get 3 euros. Okay, so previously, for example, if we say that a product was costing 2 euros, so when it gets imported into our market, the UK market, it is sold for a pound. All right, now due to depreciation in euros, what's going to happen that 2 euro product is going to be sold at a lower price in the UK. It will be less than a pound. So people find it cheaper. So people buy that instead of the local UK company's product. Okay, that means the foreign company is at an advantage. So foreign co will have an advantage in the UK market. All right, that's our final answer. Highlighted. Now in the CB platform, you will ideally have a tick box. Okay. Here I've written all the questions on the spreadsheet. Right, so that's why I'm highlighting and doing all that. In the actual exam, you need not do all that, and in the actual exam, you wouldn't be having a spreadsheet. So all these calculations you would have to do on a on-screen calculator and an on-screen scratchpad. Right. The inventory ordering policy of ZAR company is to order 100,000 units when the inventory level falls to 200,000 units, sorry, 20,000 units, and the cost of placing and processing an order is $200. So ordering cost is $200 per unit, while the cost of holding inventory is 0.5 per unit per year. Orders are received 1 week before being placed with the order. So that's like our lead time. The production requirement for next year, that is we consider 1 year to be 50 weeks, is 600,000 units. So annual demand is 600,000 units. Then our lead time is 1 week. Our cost of holding is 50 cent per unit per year. Our cost of ordering is $200. Our reorder level is $20,000, and our reorder quantity is $100,000. So everything is given. What is the cost of ZAR company's inventory ordering policy? Okay. Now, a common mistake that a lot of students would do the moment they'll read the word ordering, okay, they think that they have to calculate ordering costs alone, and they will just do 200 okay, is cost of ordering 200 into 600,000 divided by 100,000, and they'll find an answer. However, they have not asked us the ordering cost, they have asked us the inventory ordering policy cost. Okay, so the entire policy is cost. So we have to find the total cost, that is ordering plus holding. All right. So we'll say, uh, so now there are two parts to it. So one is total ordering cost. So if you see, the formula will be, now this formula is not available in your sheet. Okay, so there are certain formulas that you need to remember. They would have given, I think, the EOQ formula. Yes, they have given the EOQ formula, but not the formula for cost of ordering and cost of holding. Okay, so you need to know that. So cost of ordering is cost per order into the annual demand. D stands for annual demand, divided by the quantity being ordered. Okay, so total, so I can say total ordering cost is equal to, all right, let's just calculate that. So cost of ordering one unit or one order per order is $200. Sorry, $200 into annual demand being 20,000 units. So 20,000 divided by, um, sorry, annual demand is not 20,000, it is 600,000 divided by 20,000, sorry, divided by 100,000 is what the quantity we are ordering. Okay. So $1,200 is our cost of total ordering cost. Now we need to find the total holding cost. Okay, total holding cost is equal to cost of holding a unit per annum, okay, into average quantity. Now average quantity is Q divided by 2, okay, plus buffer units, if any. Okay, this is the formula for total holding cost. Now, do we have buffer? Okay, nothing is mentioned about buffer, but there is a way to check how much our buffer is. Okay, so normally our reorder level is demand during lead time plus buffer. Okay, now we know our reorder level is 20,000 units. All right, what is our lead time? So our reorder level is 20,000 units. Okay, this is a number. All right, our demand during lead time. Okay, let me just take this right over here. Now the demand during the lead time is, now what's our lead time? Our lead time is 1 week. Okay, so what we'll do is we'll take our annual demand, 600,000. 1, 2, 3, yeah. Okay, divided by 50 into 1 week. All right, so our demand during lead time is 12,000 units, which means there is some buffer to it. Okay, so what is our buffer? Buffer is equal to the difference between reorder level and the demand during lead time. So 8,000 units is our buffer. Therefore, if we have to calculate now our total holding cost, right, our total holding cost will be, so let me just highlight this. Our total ordering cost was here. Our total holding cost is equal to cost of holding 1 unit. So 1 unit is 0.5 cent. So 0.5 cent into quantity ordered, that is 10,000, no, 100,000 units divided by 2 plus buffer units. Okay. So $29,000 is our total holding cost. Okay. Therefore, our total cost will be the summation of the two. Overall cost is equal to this plus this. That's 30,200. Okay. So this will be our final answer, 30,200. Clear? Okay. So the key over here was finding that buffer. Again, calculation took some time. So this took some time. Even the above question took some time. That's why I suggested go start with theory first, quickly finish off all the theory. Okay. And come back, flag these, come back to it later. Okay. Or if you know that this is a strong point of yours, then attempt it first. Which of the following is most consistent with maximizing shareholders' wealth? Profit maximization, well, that we have studied, it is not equal to shareholders' wealth maximization. Market share growth isn't equal to wealth maximization. Minimizing the cost of capital. Now, if the cost of capital is reduced, cost of capital is your WACC. So, if the WACC or cost of capital is reduced, your NPV becomes positive, as in NPV increases, and a positive NPV or any increase in NPV is known to add to the shareholders' wealth. So, this seems correct. And maximizing EPS, again, maximizing EPS is to do with profit maximization, not wealth maximization. So, minimizing the company's cost of capital is the correct answer. Okay, let's move on. And identify by clicking on the relevant box in table below whether the following statements for Miller or cash model are true or false. The greater the variability in cash flow, greater is the spread between the upper and lower cash balance. Now we have the formula for Miller or available over here. Okay, let me just zoom this in. So this is the Miller or formula. Now about the spread, and they were talking about variance or variability. Okay, so variance, so spread and variance has a direct correlation. Okay, because it's in the numerator. Anything in the numerator will have a direct correlation. Anything in the denominator will have an inverse correlation. Okay, so since this is so greater variability would be greater spread, true. So we can mark this. When short-term investments are liquidated, the company's cash balance would return to the lower limit. Yes, if you remember in Miller or if cash balance goes to the upper limit, the units or the certain investments are purchased, okay, such that the cash balance comes back down to the return point. Okay, see, there's a return point, the Z. So this seems true. If interest rates rise, the spread between the upper and lower cash balance will also rise. No, interest rate has an inverse relation. So that's false. Okay. So you see, theory doesn't take much time. Luke Company has 8% convertible loan notes in issue, which are redeemable in 5 years' time at their nominal value of $100 per loan note. Alternatively, each loan note could be converted after 5 years into 70 shares with a nominal value of $1 each. The equity shares of Luke are currently trading at $1.25 per share, and this share price is expected to grow 4% per year. The before tax cost of debt for Luke is 10%, and the after tax cost of debt for Luke is 7%. What is the current market value of the loan note rounded to the nearest $1,000? Sorry, nearest dollar. Okay. Now, in order to find the market value of any instrument, we need to basically find the present value of all the future cash flows. Okay, this is common knowledge, right? So we will first say now this is a convertible loan note. That means we need to figure out that will shareholders take cash on redemption, or will they go for conversion? Okay, so if they take cash, right, let me actually put it a little above. Okay, if they take cash, okay, how much are they going to get? Redemption is at nominal value, and nominal value is $100. Okay, so they will get $100. All right. If they convert to equity, okay, on redemption, then how much are they going to get? They can get 70 shares, okay, at nominal value. Now we won't value it at nominal, we value it at what do you say, market value. So currently trading at 1.25, but we don't want current trading. We want that what will it be after whenever the redemption is 5 years. So after 5 years, what would it be? So 1.25, and then the share price is expected to grow at 4%. So into 1 plus 4%. Okay, this whole thing is raised to n. So that's 5 years. All right. So that's $106.45. So this seems better. Okay, $106 is better than let me just, yeah, $106 is better than $100 conversion. So we assume that people are going for that only. So our right, interest, and then these are the relevant cash flows, conversion or redemption, we can say conversion on redemption. Okay. Right. So interest is how many dollars? It is $8, 8%. Okay. So 8% on a nominal value of 100. I'm just showing it to you, but you can just directly take it as $8. Okay. These are all in dollar terms. So $8. And then we have our redemption. Conversion on redemption is this much. Okay. Then we need our annuity factor or discounting factor. Okay. Now for interest, 5 years, 8%. Sorry, we need the discounting rate. Now, discounting rate we have two. One is 10%, one is 10%. So a lot of time in hurry, they will discount it at the cost, the coupon rate, but they need to discount it at the yield or the cost of debt. Okay. Now, in this particular case, we haven't really, the interest we have taken before tax. So the cost of debt also we'll take before tax. Okay, so 4% will be the, sorry, not 4%, 10% will be the discounting rate. So 10% for 5 years annuity. Okay. Annuity, 10% for 5 years is 3.791, right? 3.791. And for 106, so that is a single cash flow. So we'll use discounting factor. So 10% only the fifth year, because we are getting it on the fifth year. That's 0.621. So 0.621. All right. So we can write our present values. Sorry. This into the annuity, cash flow into the discounting factor. All right. This is also a dollar. So sum is equal to this plus this. Okay, so 96.44. They said round it to the nearest dollar. So if I just round it, it's $96. Okay, so market value will be this $96. So I can mark this over here, $96. Okay, clear? See, ideally, you must pause the video when I read the question and try to answer it yourself and then check whether you're getting it right or not. Now, Simon Company is planning a 1-for-4 rights issue. The value of rights has been calculated as 40 cent per share. Um, Simon Company's market price is currently $7 per share. What is the theoretical X right price per share and the rights issue per share? Now, normally how we find TERP is equal to the market value of the current shares in issue, market value of the rights share recently issued divided by the total number of shares. Okay. So we are usually given the issue price. This is one different question wherein finding the issue price is asked. Okay. So the information we currently have is, right, so information we have is value of a right. The value of a right has been calculated and this is per share. Okay. Because it's per existing share. So per existing share is equal to $0.4. Okay. Then what else? We have the current market price. So the current market price is $7 a share. All right. Yeah, that's it. And the ratio we have been given is 4 for one right for every 4 share. Okay. So from that we can find VOR. Okay. So value of a right is equal to, now normally what we do is normally we do this. Value of a right per existing share is equal to value of a right divided by number of shares required to buy a right. Okay. So we just can rearrange it. Okay. And say that value of a right is equal to VOR per share into number of shares required. I'm just shortening it up. So value of right will be this into 4 by 1. 4 by 1 because 4 shares are required for every 1 share. So actually this is 1 by 4. Okay. But yeah. So value of a right is $1.6. So these all information we have. Now, if you have read the, so in day 1 or the first day of revision, I had suggested reading examiner's report. And in that report, you would have come across a new formula which is not there in the study text, which is TERP is equal to current market price minus value of a right per existing share. Okay, so I'll just bold this because this is a new formula. All right. So now using this, we can find our TERP. All right. So therefore, TERP, which is asked, is equal to current market price minus 0.4. Okay. So $6.6 is our ERP. So let's see, 6.6 over here. So this is marked as our TERP. Okay. All right. Next thing we need to find is the rights issue per share. Okay. Now to find the right issue per share, The formula will be, so the normal formula, as we know, it is TERP, TERP is equal to, wait, I just write it. So issue price. Now I'm just rearranging the formula. So normally our, wait, let's write it. TERP is equal, issue price is equal to, issue price. I'll write it as just to avoid any of right, is equal to TERP minus value of a right. Okay. So this is the issue price, the formula for issue price. Otherwise, TERP is nothing but issue price plus VOR. Okay. But we have just rearranged it. Okay. So then with this, you can just find out your issue price of right will be TERP. So TERP minus value of a right. Value of a right we have calculated. So $5 will be that. Okay. So we can just mark this also. So $5 is our issue price. Okay. Issue price per right. All right. Clear? This is how we, let me just shift everything by one cell. Okay. So this one was a little difficult to do, in the sense the formulas need to be known. Only then can this question be easy. Okay, so I'm just writing I have just made the formulas bold. So you know what needs to be remembered. Okay. Uh, Moving on. What role would money markets have in a letter of credit arrangement? Now, a letter of credit arrangement, if you remember, yeah, letter of credit arrangement, if you remember, is done in international trade. So what happens is, when someone is, say somebody in the US is selling something to someone in India. Okay. Now that person is not sure whether the Indian customer will pay on time or not. Okay. He wants something like a guarantee. He doesn't recognize the customer. And also, even if the customer defaults or any delay, he would have to, where will he find him? Where will he fight the case? All of that is a big question mark. So what he can do is, he will ask for a letter of credit. Now the buyer, that is in India, will go to his banker and request for a letter of credit. They will issue a letter of credit to the seller's bank. The seller bank will receive it. Okay. Uh, and then will go, the seller's bank will then intimate the buyer's bank that, yes, the goods have left the port on time. Here are the shipping document. The banker will then acknowledge, yes, everything is as per terms. Okay, so they will accept that letter of credit, and then that acceptance is given to you. Now, this acceptance, if you want money today, because the acceptance is that there is a guarantee of paying the money after, say, 3 months. Okay, that was mentioned in the contract. Now, if you want money today, you can discount this contract and get money today. Okay, so this is a little bit about letter of credit. So first one, so they are saying where will money markets come into play? Initial arrangement of the letter of credit, that is done by the buyer's bank. Acceptance of the letter of credit is done by the seller's bank. Issuing of banker's acceptance is done by the buyer's bank, and discounting the banker's acceptance, this can be done in the money market, and it can be also traded. So it is discounting the banker's acceptance is the correct answer. So let me just copy this whole statement, paste it over here, and I'll just mark it, highlight it. Okay, moving on, question number 9. Warren analyzes publicly available information about firms and use this to predict their share movement. To what extent does Warren believes capital markets to be efficient? So market inefficiency means the price factors in no information. Okay, weak efficiency means price factors in only the past available information. Semi-strong means publicly available, which is just got available, as in current information as well as past information. Current information is just available public information. Okay, and strong form of efficiency means past information, the present information, present public information, and also insider information, which is not out in the public. All of these three informations are built into the price, or the price is factoring in all these things. Now, the moment somebody reads publicly available information, they will move on to semi-strong and mark this. However, if Warren believes that already public information is built into the price, then there is no point analyzing that information because it's already factored in by the price. Okay, what he's trying to do is he is trying to do fundamental analysis, and fundamental analysis works in weak form of efficiency, wherein only the past information is factored in. There is merit. Okay, there is an advantage if you study the current public information which just got released, study it, analyze it, and accordingly take action whether you want to buy or sell, because it will take some time. In a weak form of efficiency, it will take some time for this latest information to get factored into the prices. Okay, when this present information becomes a little old, okay, it becomes past information, only then will it get factored in. Okay, so weak form of efficiency would work. Only then can he beat the market, okay, or predict where the share price would go. Now, SMEs often face a funding gap problem. Funding gap means whatever their requirements are, okay, they are not, whatever their funding requirements are, they are not able to get it. Therefore, there is a gap. Indicate whether the following statement about SMEs are true or false by selecting a correct answer next to the relevant statement. SMEs will often experience a funding gap due to them being seen as a higher risk investment than a larger company. Yes, they are small companies, they are riskier because there is no um, proven track record, experience management, all of that. Okay. Founding shareholders of an SME will have to sacrifice limited liability in order to obtain bank finance. What this basically is trying to say is the founding shareholders, which means the promoters, will have to sacrifice limited liability. So normally, promoter of a company does not have full liability. It is the company that has full liability, but they will have to sacrifice that. Okay. And have certain personal liabilities. Okay, why? Because for the bank to give loan, they need certain assets. Now, if it's since it's a SME, it may not have that much assets. So the promoter will have to give its personal asset as a security and take a loan. So this is correct. They will have to sacrifice that. A lack of suitable and sufficient non-current asset of assets increases the funding gap problem for an SME. Yes, we already discussed that there are not adequate assets. Okay, so yeah, all the statements seem true. A company that has $10 million loan with a variable rate of interest, okay, has acquired a forward rate agreement, that is a FRA, with a financial institution that offered 3.6 or sorry 3v6. Okay, that means the loan is going to start after 3 months and will end after 6 months. Okay, so 3v6, that means the duration of the loan is 3 months. The spread is 3.2, 2.7. That means we are borrowing over here, so our borrowing rate will be 3.2. What would be the payment made to the financial institutions under the term of the FRA if the actual rate of interest was 3%? So if you know, in the FRA, there are two transactions that take place. One is the actual loan taken. Okay, first transaction is actual loan taken, okay, which is currently at 3%. What happened? Oops, what's happening? Wait a minute. Yeah, actual loan taken at 3%, and then the FRA will get executed at, or would rather be closed, okay, at 3.2%. All right. So there is, what is the difference between the two? Okay, so the difference will be settled. Okay, so difference is, now over here in FRA you have to pay more, 3.2%. Okay, so 3.2% minus 3%. Okay, now this is for 3 months, so 3 by 12 into a $10 million loan. So I'll just write it as 10. Okay, so these many $1 million paid, okay, by the company to the FRA. Agent, we can call it. Okay, which means now they are asking to the nearest dollar. So what we can do is this into, we know it's $1 million. So 1, 2, 3, 4, 5, 6. Okay, so $5,000 is your final answer. All right. So our difference is settled over here. Now, next question. Dinla company has an annual credit sales of $4.5 million and an average customer takes 60 days to pay. Assuming a 360 days year, as a result, Dinla has a trade receivable balance of $750,000. Dinla relies on an overdraft to finance this at an annual rate of interest of 8%. Dinla is considering offering an early settlement discount to its customers of 0.5% for repayment in 30 days. It expects 25% of its customers, which represents 35% of annual credit figure, will pay on 30 days in order to obtain the discount. If Dinla introduces the proposed discount, what will be the net savings? Okay, so we need to calculate net savings. Now, this seems like a big question. So, ideally, you may want to just do it a little later, save your time, move on to the next questions. Flag this. Okay, mark something, flag this, and move on to the next question. Okay, but here we will solve it first. So, Dinla has an annual credit sales of 4,50,000, sorry, $4.5 million. So we'll write first. What? Why is this not one? Yeah. Okay. Annual sales. Annual credit sales is for $4.5 million. Okay. Now, okay. So in order to understand the savings, net savings, we need to first find out the cost. The cost is the discount. Now the discount is given to the creditors. Okay, and what sort of savings we are doing. Okay, so how can we calculate our savings? So in order to calculate the savings, basically whatever we were financing. Okay, so if you see over here, from 60 days, So previously the customers were taking 60 days. Those who took the discount took only 30 days. That means 1 month financing we will save, but not on all customers, only on 25% customer, which represents 35% of the annual sales. Okay, so since we have the annual sales, we will take 35% only. Okay, so the current receivables, if you see, our current receivables are, what is our current days? 60 days divided by 360 days into the annual sales. Okay, they are, our receivables are valued at sales figure. Okay, so $750,000 is our current receivables, which they have also given over here explicitly. So we didn't have to calculate it. I didn't see that, but it's given over here. Okay. Financing the current receivables with the OD. Okay. Let me just write the full thing. Okay, I don't think there is space. Okay. So, how much, what sort of financing we are doing currently? Um, Annual rate of interest is 8%. Okay, so into 8% into how many months? So you are taking 2 months, okay, or we can just stick to days, 60 divided by 360. Okay, so $10,000 is what we are doing in, wait, what happened? Yeah. Uh, okay, sorry, not 60 divided by 360 because this will keep recurring. Okay, so it's $60,000. See, the reason we didn't take 1 month, okay, of financing is because this is total receivables. It will keep like for 60 days, these will be the receivables. Then after 60 days, again, they'll be the, because it's a cycle, right? Okay. So current financing is $60,000. Now, how much discount do we give? So these two informations are given. Based on that, we found out what is our financing. Okay, 8% overdraft. Now next discount is 0.5%. So discount given to what percentage of sales? To 35%. Okay. So discount given to 35% of the sales. So this into 35% into the discount amount was 0.5%. So is equal to $7,850. Okay, this will be our cost. Now, against this cost, what benefits we get? The benefit that we get is our financing cost will come down. Okay, so it will be less than $60,000. Why? Because certain people have paid earlier. Okay, so what is our new receivables? So new receivables, that is post discount. Okay, now there are two types of people: discount takers, okay, and others. All right, so discount takers are going to take 30 days, 30 divided by 360 into sales, but they are representing only 35% of the sales. So 131,250. Others are basically taking the same 60 days divided by 360 into this annual sales, and they are the balance. Okay, so 1 minus 35%. You can directly do even 65%. Okay, here I'm just showing the calculation. So 487,500. So total number of total new receivables is equal to this plus this. So 618,750. Now bank financing on these would be, okay, bank financing the new receivables. Okay, so this into 8%. All right, 49,500. So how much are we saving? Savings on overdraft facility. So initially this minus the financing cost over here. So 10,500 is our savings over here. Let me just make it bold. This is our savings. That is benefits. Okay, so we are doing like a cost benefit analysis. Okay, so our savings, net savings will be, total savings is this much against a cost of $7,875. So that means this will be our net savings. Okay, we can just mark this. Okay, this is our final answer. Right? Moving on. Let me just see everything is correct. Uh, yeah. Okay, moving on. The following are extracts from the statement of P&L for IQ company. Sales revenue, cost of sales, profit before interest and tax, interest, profit before tax, tax, profit after tax, everything is given. 60% of the cost of sales is variable. What is the operating gearing of IQ company to 1 decimal point? Now, operating gearing is basically talking about the fixed costs, okay, against the total cost. Now, there are various formulas for operating gearing, and none of them is given over here. Okay, so we need to remember those formulas. Okay, now there are several formulas, but let's see what all variables we have and if we can plug in any of the formulas. So 60% of the cost of sales is variable cost. Okay, so 60% of cost of sales. So there is no cost of sales. Okay, that's missing. Now I don't know whether it's a typo or it's actually missing, but we can easily find it out. Sales minus the profit before interest and tax is our cost of sales. Okay, and if we want to find out our variable cost will be okay, let's see, our variable cost will be 60% of this. All right, these are all in dollars. Okay, similarly this is also in dollars. Okay, and it's $1,000 over here. All right, so this does not mean it's $60,000. It's 60,000 into 1,000. Okay, 30,000 into 1,000. All right, so we found our variable cost. Now, since we have our variables cost, so sales minus our VC will be our contribution. Okay, so our contribution can be sales minus variable cost. That again is $30,000. Okay. Now there is one formula that says that operating gearing is equal to contribution by EBIT. Okay. Other way is fixed cost by what happened? Just a moment. Do you want to turn? No. Just got a sound. Yeah, the screen is there. Okay. Operating gearing is equal to contribution by EBIT. Other formula is fixed cost by total cost, fixed cost by variable cost. Now we don't have fixed costs available. Okay. One way of doing it is if 60% of the sales is variable, we can assume that 40% of it is fixed. Okay. But it varies. Okay, marketing and all may vary, so we don't know how the whole costing is being done. Okay, we'll have to assume, but anyways, we could use, this is one of the other formulas that we can use. So we have EBIT is nothing but profit before interest and taxes. Contribution also we have, so we can just directly do it. So sorry, is equal to contributions divided by EBIT is equal to 3, and they are saying to 1 decimal point, so we will shift it 1 decimal point, so 3 will be our final answer. Okay, identify by clicking on relevant boxes in the table below whether the following statement about investment decision making methods are true or false. Okay, discounted payback method takes into account cash flow for all periods. No, that's in fact a limitation. Okay, it just stops after you get the payback period. The payback method ignores all cash flow from the end of the target. After the end of the target payback period, it ignores all cash flow after the end of the payback period, not target payback period. Now, your target payback period may be 5 years, okay, and your actual payback is 4 years, in which case you will accept the project because it is quicker than your target. Okay, so target is only used for the decision, so this statement also will be false. The accounting rate of return is to accept investment opportunity when their rates of return exceeds the company's WACC. No, that is IRR. Accounting rate is if it is higher than the target IRR or ROCE, then we will accept it. So this is also false. IRR is to reject the investment if the WACC is greater than the internal rate of return. Yes, if your cost is greater than the returns, then you will reject it, and that's what IRR says. Okay, so this is true. Which of the following statement about interest rates are true? In a period of high inflation, nominal interest rates are higher than the period in low inflation. Okay, so in period of high inflation, so when inflation is high, nominal interest rates are also high, is what they are saying. Yes, which is true. Okay, nominal rates is nothing but your real rate into the inflation. Okay, so nominal rates are always higher, and it's a function of inflation. Okay, so if inflation goes up, your nominal interest rates will also go up. Okay, so that seems true. Long-term assets are usually lower. Sorry, rates are usually lower than short-term interest rates. Long-term rates are not lower. Long-term interest rates are in fact higher. Okay, in normal cases, because long-term loans are considered more riskier. Okay, there is a risk that whether the person may not be able to pay the money on time. Okay, after 5 years, but after 1 month or after a few months, high likelihood he will be able to pay given his current condition. So it's only one. Okay, so we'll just mark this, and with this it brings us to the end of section 1. We took about an hour to do it, and because I was explaining without explanation, within 50 minutes we would easily do. Also, I have written a lot of these extra information, okay, which need not be written. You can directly, like, you need not write these two, you could just directly do the formula and get your answer. Okay, these may be, if you write it, there will be clarity, so it's better to write this, but certain things you can easily do it directly. You need not write each and every step, because at the end of the day, the question paper or your answer is section A and section B is corrected by a computer, which is not looking at steps. Okay, it is just auto checking the function or the command it has been given is, if the answer is one only, give 2 marks. If anything else, then give 0 marks. Okay, that's it. So let's move on to section B. Now, before section B, let's take a quick 5 minutes break and we'll be back in 5 minutes. Okay. All right, welcome back. Let's start with section B. Um, so the following scenario relates to, so as we discussed in section B, there'll be 3 case studies, 5 questions relating to each case study, 2 marks each, MCQ type. Okay, so following scenario relates to 1620, Radian company whose home currency is the dollar expects to receive 750,000 euros from a credit customer in the European Union in 6 months' time, and to pay 500,000 to a supplier. So he's receiving 750 and in 6 months and has to pay 500 in 12 months. Okay, so we cannot net or match it off. uh, we will have to, so these are two separate transactions because 6 months and 12 months. Had they been in the same month, like 6 months and 6 months, then we could have matched it and have a net exposure. But in this case, we have individual exposures. The spot exchange rate is 2.349 euros per dollar, and the following interest rates are available. Okay, so we have our deposit rates and the borrowing rates available with us over here. Okay, why is this given rate? This is rate. Wait. So euros, dollars, borrowing deposit rate is the inflation rate in Radian company's home country is 1.5% per year, and in EU it is 3% per year. What should Radian company do now to correctly set up the money market hedge on the 750,000 euro receipt expected in 6 months' time? Okay, so we know that now we have to set up a money market hedge. They are just asking us for one transaction. We need not set up the entire hedge. Okay, so for one transaction, what do we do in? They are asking what are we doing with the 750 receipts? Okay, in 6 months' time. Now, so in the European market, what are we going to do? We need to ask ourselves that. So the first question is, what is going to happen after 6 months' time? After 6 months' time, we are going to receive 750 euros. Okay. If we are going to receive euros, that means we are going to create a liability of 750 euros today. So that that liability will mature, or that borrowing will mature to 750, and once we get the payment from the customer, we will take that payment of 750,000 euros and pay off the bank. So we are going to borrow in euro. Okay, how much are we going to borrow it at? So 8% per annum per annum. Okay, so that means for 6 months, how much will it be? For 6 months, it will be this into 6 by 12. Okay, so that's 4% for 6 months. Right, so how much, what is the future value of this borrowing, as in the maturity? We need to borrow X amount such that it matures after interest and becomes 750 euros. Okay, let me just put this as a euro. So what is the present value of this? Okay, after 6 months, that is future value is 750. Then what is the present value? It's very simple, just discount it. 1 divided by 1 plus r. Now no need to do raised to n because we have already adjusted the r. Okay, so both of these, let me just format it, 721. Okay, this will be our answer. So you're going to borrow 721, 154. All right, very easy to calculate. Now, which of the following would correctly hedge on the 500,000 payment expected in 12 months' time? Now, we have to pay. We are a US based company, pay euros. That means we need to buy euros in the future. Once we buy euros, and then we can pay it off. So option number one, buy future euros. Yeah, that seems correct. So just mark that. Got lucky, but we'll still read forward rate agreements. But what about forward rate agreements? Buy or sell? Okay. Uh, Today borrow euros. Why should I borrow euros from today only and pay interest over it for 12 months? I need it after 12 months. And put option. Put option is the right to sell euros. I don't want the right to sell. Want the right to buy. Want the call options. Okay. So yeah, buy euro futures is the correct answer. Now, Radian company continues to trade with EU for many years, to which the following currency risk will be potentially be exposed to: transaction risk, translation risk, and economic risk. Now, if you see what are the meaning of transaction risk is, if the transaction happens today and the settlement, or rather if the invoicing is done today and the settlement or the transaction happens on a later date, between these two dates the exchange rate could change. Okay, that would lead to some fluctuation in your inflow or outflow of cash. So transaction risk, this company is definitely going to face when it's going to deal with the EU for many years. Translation risk. Now, translation risk is a bookish risk when you are doing a consolidation. Okay. Now, this particular company does not have they given anything about expects to receive a credit? No, it does not have a company in the EU which is dealing continuously. Okay. So there is no translation risk. And economic risk, yes, for a long term, if you are trading with a particular country, the country may experience certain economic conditions like inflation or deflation or some political unrest or whatever, higher interest rates, whatever it is. Okay. Which has a long term effect on the exchange rate. So both 1 and 3 are correct. So you can just mark this. All right. Which of the following would be 12-month forward exchange rate? So we need to find out what is the 12-month forward exchange rate. Now, if you remember, there were formulas for it. Okay. So if you see over here, we have purchasing power theory, but that gives you the forward rate. Okay. And then we have the future rate available. Okay. So we are going to use, let me just zoom this in for you. We are going to use this. All right. Forward rate is equal to S0 into 1 plus interest of the counter currency divided by 1 plus interest of the base currency. Okay, and this is inflation. All right, so let's just write that formula down first. So it was F0 is equal to spot rate into 1 plus interest on counter currency divided by 1 plus interest on base currency. Okay, this is the formula. Now we already have, let's see if we have them or not. Interest on, now we have two rates, okay, for home currency, and we don't know which rate to take, deposit rate or the borrowing rate. Okay, so again, in one of the examiner's report, they had explicitly mentioned in such a case, we shall take the average rate. So average in Europe and average interest rates in dollars, okay, or in US. Okay, and then we need S0 also. Okay, and we can find F0 then. All right, so what is this? Average interest rates in European Union is 4 and 8. So 4% plus 8%, everything divided by 2. So this many percent, that's 6%. okay, and is equal to, in the US, it is 2% plus 3.5% divided by 2. So that's, let me just convert it into percentage form so you'll understand. 2.75%. What is the spot rate? The spot rate is already given, 2.349 euros per dollar. Okay, so F0 is equal to this into counter currency. So this is counter currency divided by home currency. So F0 is equal to 5 point, wait, have I made any mistake? Because 5 point is not available. 2.349, 38. 38 is counter currency divided by, yeah, it seems correct. Have I done some calculation mistake? Is equal to spot rate into, oh, these are to be in decimal terms. Okay. So just put it in decimal terms. Sorry. No, it's same. Okay, let me just try doing it again. 2.349 into one. Oh, it was 1 plus. Okay, sorry. 1 plus the counter currency divided by 1 plus the base currency. Let me just put the brackets properly. Okay, yeah, this makes a little more sense. 2.423. Okay, so yes, this will be our final answer. Okay. So question number 19. So just keep in mind you need to take the average rate. And the US average rate. Okay, so just keep these things in mind. Okay. Now they could have complicated this by giving us two rates and then we have to select from that, but fortunately in this case they haven't. So it becomes easy. Radian company is planning to issue debt and is considering the use of interest rate derivatives to protect against the rise in interest rates. Oh, so we are moving on to the next question. Which of the following, oh no, it's the same. Okay. Which of the following statements are correct? Interest rate options allow the buyer to take advantage of favorable interest rate movements. Yes, options always give you that flexibility, so we can take advantage of a favorable movement. A forward rate agreement does not allow a borrower to benefit from a decrease in interest rate. Correct. Forward rates essentially lock a rate. Okay, so it's an obligation you have to execute at the FRA rate. Okay, so we cannot take any benefit if the real interest rates fall. Okay, or at the actual interest rates fall. Borrowers hedging against an interest rate increase will buy interest rate futures now and then sell them at a later rate. Okay, so now if we are thinking from futures point of view, we say that the underlying is a bond. Okay, so if you are issuing, if you are borrowing, that means you are issuing bond, that means you are selling bonds. So you, to hedge, you will be selling the IRFs, not buying them. Okay, so only 1 and 2 seems correct. All right, moving on. Next question. As in the new case study. So the following information is available for Cactus Company. We have the current forecasted annual earnings, and listed companies similar to Cactus company has an earning yield of 8.2%. Cactus company also has an issue loan notes with a nominal value of $1 each. Interest on the loan notes is 6% per year, payable annually. The loan notes will be redeemable in 8 years' time at a 5% premium to nominal value. The before tax cost of debt to the company is 7% per year. A Cactus company has no other debt in issue. Okay. Which two of the following may explain the forecast rise in Cactus company's earnings? Okay. A decrease in the dividend payout. Yes, this can be correct. Okay. When the dividend payout would reduce, what's going to happen? You will have more retained earnings. Okay. Which you can invest and make more money on. Okay. Also, retained earnings is a cheaper source of financing, so your overall cost of capital will also reduce. Management myopia. Now, management myopia basically means that management is focusing on short-term gains and not long-term. Okay, so this seems correct. I think the first two statements were only correct. So, a share repurchase program, well, a repurchase program will just increase your earnings per share, not the total earnings. Okay, because the number of shares have reduced, and if your earnings are same, then it will be divided amongst lesser number of shareholders, which means EPS goes up, not total earnings. Expected fall in interest rates in the economy. Well, if there is a fall in the interest rates in the economy, okay, your interest rates will ideally come down. Okay, but they have a fixed rate loan which is at 7%. Okay, and there is no other debt in issue. So it's not going to really impact the company. Okay, sorry, not 7%. It is loan note is 6% per annum. Okay, so the loan note is at 6% flat. It's not a variable loan note. Okay. Uh, Yeah, nothing about variable, just one rate is given, okay, which is fixed. If it was a variable, they would give us information like base plus certain change in the rate. All right, so we have that. Now, question number 22, what is the total market value of a Cactus company using earnings yield method? So using the earnings yield method, so if you know the formula is price is equal to earnings divided by the yield. The actual formula is yield is equal to earnings divided by price. Okay, so I'll write the actual formula also. Okay, yield is equal to earnings divided by price. This is the actual formula, but we have rearranged it and we get price is equal to earnings divided by yield, which essentially is just take the earnings. How much is the earnings? The current earnings is these many $1,000 divided by the price. The price per share is, sorry, we are finding the price. So what is the yield? Now, the listed company similar to is 8.2%. Do we have the Cactus company's yield? Interest rate. This is the, no. Okay. So we will just stick to 8.2%, right? So these many $1,000 will be, okay, so the final answer would be this into $1,000. Oh, they said nearest million. So these are actually in $1,000. So let me just multiply it over here only, just to avoid any confusion, basically. This is the final answer. Okay, so that means it is dollar 169 million. We are rounding it up. Why? Because it is 168.7. So we will make it 169. Okay, 5 and below, or anything below 5, we'll round it down. Anything above 5, we'll round it up. What is the X interest market value of each of Cactus Company's loan note? Okay, so we in the previous in section A also we had done the pricing of a loan note, which is nothing but the present value of all future cash flows. So loan note typically has two cash flows. One is the interest, okay, and other one is the redemption proceeds. Now interest is how much? Is equal to 6% per annum. So 6% to 100. Okay, nominal value is 100, and redemption will be, loan notes will be redeemed at 8 years time at a 5% to the nominal value. So nominal value is 100, a 5% premium, 1 plus 5%, not into 5%. Okay, so that's $105. So this is our cash flow. Okay, and what is our annuity factor or discounting factor? Now, in case of interest, it's an annuity, so annuity factor will be, now what was our discounting rate? Now, discounting rate, we have 7% per year. Okay, before tax cost of debt. Yeah, we want before tax cost of debt. So 7% per year because our interest is also before tax. So 7%. What is this present value? No, we need annuity. 7% for how many years was it? 8 years. 7% for 8 years is 5.971. Okay, so 5.971. And redemption, this is 7% only on the 8th year. So we need discounting factor table, 7% only on the 8th year because it's received only on the 8th year. So 0.582. 0.582. Okay, so present value will be this into this, then summation of these two. Okay, $96.9. This will be in dollar terms. Highlight it, is equal to 96.94. Okay. If the Cactus company issues additional loan notes, that will affect on the WACC according to the traditional view of capital structure. So if you remember the traditional view, it said that the cost of debt is cheaper than the cost of equity. Okay. However, as more debt component increases, financial risk will increase. And since financial risk will increase, the equity shareholders is going to perceive the company to be riskier, due to which the expected cost of equity or expected return would go up. Okay. But the traditional view also said that up to a certain limit, the cheapness in debt due to the rise in debt is going to bring down the WACC, because the cheapness of debt is able to compensate for the rise in cost of equity. However, after that minimal point, okay, if you keep increasing debt, then the cheapness of debt is not able to compensate for the rise in the cost of equity. So the net effect will be increased. So the WACC will increase. So if you remember in our notes, there is this diagram, okay, under the traditional capital structure theory, which said that WACC initially starts moving down, and then at the lowest most point after that, it starts moving up. Okay. So it can either rise or fall depending on which situation you are in. Okay, so it will fall or it will rise. That is not, as in, it will fall as cost of debt is below the cost of equity. True. It will rise due to increase in financial risk. True. Okay, but we can't say for sure what is going to happen because it's trial and error method only. So it may rise or fall. The chairman of Cactus Company has been reading about capital market efficiency. Now, we have already discussed again in section A. Identify by clicking on the relevant box in the table below whether each of the following statement is true or false. If the capital market is weak form of efficiency, an investor cannot make abnormal returns by using technical analysis. Okay. Now, in a weak market, we just discussed in A that fundamental analysis is useful and technical analysis is for no efficient, okay, or inefficiency. So this is cannot make, okay, so this is true. Operating efficiency ensures that capital markets direct funds to their most productive use. No, capital markets have nothing to do with operation efficiency, okay, but has to do with financial gearing, okay. So this will be false. Tests for semi-strong form of efficiency focuses on the speed and accuracy of share price response to arrival of new. Yeah. So if immediately the new price information is factored into the price immediately, that means it is a semi-strong form of market. So this statement is also true. Okay. Now moving on, next question. Um, so the statement of financial positions of SVB is given to us. Okay, so we have the ordinary shares, we have reserves, non-convertible liabilities, all of that is given. SVB has an equity beta of 1.2 and an asset beta of 0.9. The ex-dividend market. Now we are usually, okay, I'll just read. SVB has an equity beta of 1.2 and an asset beta of 0.9. The ex-dividend market price of the company's equity is $250 million. The ex-dividend market value of the preference share is $6.25 million. Convertible loan notes of SVB company have a conversion ratio of 19 ordinary shares per $100 nominal value loan note. The conversion date and redemption date are both on the same date in 7 years' time. The current ordinary share price of SVB company is expected to increase by 4% per year for the foreseeable future. The equity risk premium is 5% per year and the risk-free rate of return is 3% per year. SVB pays tax at an annual rate of 30% per year. So almost everything is given to us. Now we are asked to find the wait, let me just delete this. Oops. Okay, we are asked to find the ungeared cost of equity. So normally what we do is we do cost of equity is equal to risk-free rate plus, this is as per CAPM model, plus beta into RM minus RF. RM minus RF is the market premium or the equity premium. Okay. Now this beta that we take is usually equity beta. All right. But here they are asking us to find out the ungeared cost of capital. Ungeared cost of capital means zero gearing, as if it's all equity financed company, which essentially is the asset beta or the ungeared beta is what we have to take. So cost of equity will be, now we have, let's see what all information we have. Risk-free rate is already given to us, 3%. Plus beta, now we want the ungeared beta, that is the asset beta, beta. Yeah, asset beta is given plus 0.9. Okay. Into, now we need the market premium or market returns. We have the equity risk premium is given. So RM minus RF is given. Okay. So into 5%. Okay. So cost of equity is 7.5%. All right. 7.5%. Okay. Just remember that RM minus RF, the entire thing Okay, put it in brackets, is um, what 5%. Okay, risk-free rate is 3%, and ungeared beta, or the asset beta, is, what is it, 0.9. So 7.5. What is SVB's cost of preference shares? Now, cost of preference shares, the formula is KP is equal to dividend divided by price. Okay. Now, dividend per share is, or we can just write DPS, dividend per share is equal to, what is the percentage for 5% preference share? Okay. So 5% on a nominal value of $1. Okay. So dividend per share, this is in dollar terms, okay, is this much. Now, dividend divided by price. So what is the price? Okay. Now, price, this is nominal value. Ex dividend market value of the preference shares is 6.25 million. Okay, so 6.25 million is the price. So this is total market value. Okay, so total value, or total market value, all right, is $6.25 million. Okay, so what is the price per share, or the market value per share? This divided by this. And these are ex dividend, which is what we need. Okay, so X price, sorry. That was BPS, total mark. So we need number of shares firstly. Okay, so number of preference shares is, okay, number of preference shares. Now we know that there are how many? 10 million book value. So 10 divided by what is per share value? $1. So 10 million units, or 10 million shares are there. Okay. So we can now find the per, or X dividend per share, price. Okay, is equal to total share value divided by total number of shares issued. So $0.63. Okay, so KP will be, now dividend per share divided by X dividend or price. Okay, that is 0.008, which is 8%. So 8% is the correct answer. Right. Moving on. Rank SVB company's security security in terms of risk to the investor by placing the tokens in order highest to the lowest. So highest risky will be, okay, or let me just rank it. So this will be first, which is most risky. Okay. Then second one will be preference shareholders. This will be second. And convertible loan note will be the least risky. This is the safest or the lowest risk, we can say. Okay. Moving on. Oh, this is the last question. Question number 30. Identify by clicking on the relevant box in the table below whether each of the following statement is true or false. The asset beta reflects both business risk and financial risk. No, asset beta is ungeared beta. That means it removes the gearing effect, removes financial risk. It's basically an all equity finance company. So this is false. Total risk in the sum is the sum of systematic risk and unsystematic risk. True. And assuming that the beta of the debt is zero, will understate business risk when ungearing and equity beta. Wait, let me just read that again. Assuming that the beta of debt is zero, so we assume that beta of debt is zero, uh, it will understate the business risk when ungearing and equity beta. Okay, so doesn't seem correct. I think it is a false. We'll just mark it false. Okay, assuming that the debt is zero, beta of debt is zero. That means a debt is risk free. It is going to understate business risk. No, it won't have any impact on business risk. It's a separate thing itself. So no. Okay, when ungearing and equity beta. So we'll just say false. Moving on, section C. Now, section C, before we do, okay, let's just take a quick 5-minute break and then come back to section C. Okay, so 5 minutes break. Okay, welcome back. So let's start with the last section, section C. Now, as we had done earlier, we'll first read the requirements and then move on to the question. Requirements is calculate the value of the factor offers um, on a with recourse and non-recourse basis. This is for 8 marks. Comment on the financial acceptability of the factors offer and discuss the possible benefits of Boulder companies factoring its trade receivables. So the advantages of factoring and how discuss how the credit worthiness of potential customers can be assessed. So credit worthiness we had discussed in our classes was you could look for bankers reference or trade references. That means reference of people who have already dealt with the company before. Okay, so you can understand whether they are paying on time or not. You can look at rating agencies rating to understand how financially stable they are. Okay, can look at their published informations like sales and P&L balance sheet information so that we get an idea as to whether they have the cash flows wherein they can pay us on time. Okay, and factors benefits would include your well, factors are experts because they do that day in and day out, so they are expert at credit risk management. Okay, and they are also experts in receivables management. All right. Then it takes away from the management in the sense that management can now focus on the business because they have outsourced the credit management to another agent altogether. So they can focus on operations and business. Then it helps reduce bad debts. Okay. It would also eliminate bad debts if you have gone with non-recourse factoring. You will get financing also from the factor. So you need not negotiate with the bank. So all those are the benefits of factoring. Now, let's do with recourse means that bad debts we still have to bear, and non-recourse means that bad debts will be borne by the company. Okay, so let's just read now. Extracts are given. These are the revenue, profits, all that, equity, everything is there. Factor has been offered to manage the trade receivables of Boulder Company in a servicing and factor financing arrangement. So both servicing and factor financing, both it's going to do. The factor expects to reduce the average trade receivables collection period from its current level to 35. So not by 35 days, but it becomes 35 days. Okay. So to reduce bad debts from, okay, so one thing is reduced level of days, so 35 days, then reduced level of bad debt from 9.9% of revenue to 0.6% of revenue, and there is a savings of 40,000 per year in admin costs. Okay, so let's write down these four informations. Wait, let me just delete this big cells. Okay, so reduce receivable days, okay, that is after factoring. Okay, so it reduces to 30. Wait, what was it? 35 days, zero point 0.9, zero point 0.6, and 40,000. Okay, so 35 days. Then previous percentage of bad debts, it was 0.9% of revenue, and then reduced bad debts after factoring becomes 0.6% of revenue. This is 0.9%. Okay. Then admin costs saved is rupees, or sorry, is dollars 40,000. Okay, what else? Per year additional. The factor would make an advance of 80% of the revised book value to the trade receivables. Okay, so 80% of the receivables are financed. Okay. The interest rate on advance would, let's just write that down. All right. So advance financed or given by factor is 80% of new receivables. Okay, then what else is there? The interest rate on advance would be 2% higher than that of 7% that Boulder Company currently pays in its overdraft. So currently the bank OD is 7%. Bank OD is 7%. And the additional interest charged by factor is 2%, which means it's taking an total of 10%. Okay. What else? We read that the factor would charge a fee of 0.75% with 0.75% of revenue on a with recourse basis and a fee of 1.25% on a non-recourse basis. Well, obviously, non-recourse means there is like a protection from bad debts. There's an insurance against bad debts. That means you are not going to suffer from bad debts. It is the problem of the factoring agent. Okay. So 1.25% is the fee in that case. So factoring fee with recourse, okay, and without recourse. So with recourse, it is 0.75% of the revenue, and without recourse, it is 1.25% of the revenue. Okay, so this is like our this is like our financial summary over here. So we need not keep referring to the question every now and then. Now we need to find so we'll just label it question number 31, subsection A, subsection 1. Okay, so first they are asking us to find value of the factors offer. In order to find the value of the factors offer, we basically have to do a cost benefit analysis. Okay, so first, what are the benefits of factoring with recourse? Okay, so they asked us subsection 1 is with recourse, so we are going to do that first. Let me just make this bold. Right, so the current, so our sales is how much? Sales is sales is this many $1,000. Okay, okay, these many thousand, so $2.1 million is our sales. What is the current receivables? Now the current receivables will be is it given? The balance sheet, it should be given somewhere. The current assets, inventory, and trade receivables. Yes, it is given. Okay, so in 2000, so $3.5 million is the current receivables. Okay, now the new receivables after factoring. That is after factoring will be, so they say that it is reduced to 35 days. So 35 days divided by 365 into the, we value our receivables on sales. So into this. So 204 to $47 is what it will reduce to. Okay. So wait, let me just see if I took everything correctly. This new receivables 35. Yeah, 20. That's a huge reduction. IC, IVA, PL. Okay, no, there's some error that can't be. It's a huge reduction. Assume that 365 working days in each from its current level to 35 days. Let me just redo the calculation. 35 days divided by 365. Okay. And receivables, we are going to value it on sales. Sorry, what just happened? Oh, yeah. For sales, I had multiplied it into 100 only, not 1000. It's actually a $21 million sales. Okay. It's 21,300 into 1000, not because these are all in $1,000. I did a multiplication of 100. Okay. That's what I was wondering. That's a huge drop in. So there should be some presence of mind to understand that it can't be so huge. Okay. So yeah, reduction in the receivables is this much. Now, what are our savings, all the savings that we are experiencing? Okay, so we'll see first savings is savings in financing cost. Okay, that is the overdraft. All right, so if you see that we would have to just fund little of it, as in our receivables have dropped, so we will be funding less. So these into, okay, where is our receivable? All right, $102,000 is what we are saving in financing cost. That is the overdraft financing. But understand that we won't be using overdraft financing. We are basically going to be using this thing, factor financings, and factor financing is 2% more, but we'll take it into consideration when we are doing our costs. Okay, so firstly, we are saving bank OD, whatever the cost is, to the tune of this much, because there is a reduction in receivables. So we are doing that. Then we are doing savings and admin cost. So admin cost savings is how much? $40,000. Okay. Then bad debts reduced That means which were anyways lost, but now lesser bad debts for us. So bad debts are becoming 0.6% of the sales. Okay. Bad debts becomes 120,000. Oh, it's reduction. So it will be zero point 0.6 is what it becomes. So it is basically the savings is 0.6 minus, sorry, zero point 0.9 minus 0.6. Okay. So $63,900 is the bad debts reduction. Okay, it was 0.9%. Now it has become 0.6. So how much, by how much is it reducing? By 0.2%. Sorry, 0.3%. Okay. So these are all our savings. So our total savings is sum of all of these. So $205,927 is our total savings. Now next is cost of factoring with recourse. So what are our costs? We are going to pay a factoring fee. Okay. Now since this is with recourse, so we are going to pay 0.75% of the revenue. Revenue is this much. All right. So okay, I'll format it later, but this is our factor fee. Then we have factoring finance, that is the additional interest that we will have to pay. Okay, 2% additional interest on the new receivables it will become. Okay, so 2%, where was it? Did we write advance given? Yeah, 2% is the additional factor that we are going to charge into. Now this is used for financing the entire receivables, that additional that we have to pay. It's not only on this thing, savings, okay, reduction. So we are going to take the whole new receivables. So wait a minute. Sorry. Yeah. No. Factor financing is wait, is equal to 2%. Oh, 80% of the receivables. Okay, so 2% into 80% into the new receivables. So new receivables is this. All right, so $32,679 is what we are going to pay. So factor financing will be on the entire receivables, whereas the savings in OD will be only on reduction, because that much your receivables have reduced by. So that much you don't have to do OD financing at all. Okay. And in this case, there is an additional that you have to pay, which is on the entire receivables, not on the savings. Okay. So just keep that in mind. Therefore, our total costs will be sum of these two. Okay. So that's our total cost. So net savings on factoring with recourse will be total savings minus total costs is equal to $13,498. Okay, we can just highlight this. Now what we can do is we can copy paste the entire thing and do, sorry, entire thing. So right now this is subsection 2, and now it will be factoring without recourse. Okay, without recourse. That means, now what is the difference between with recourse, without recourse? Your entire factoring, as in your entire bad debts, moves out. Okay, so this is without recourse. Okay. Now, if you see, current sales and everything will remain same. So we are just going to take the same. Current receivables. There's no impact on receivables, new receivables. Okay. Reduction in receivables. Okay. Let me just format all of these. Okay. So savings in financing the OD. So now this will also be the same. So basically only one number will change. So savings in financing the OD will be the same. Admin costs saved will be the same. Okay. Now bad debts, you are saving the entire bad debts. So which previously you had 9% of bad debts, that becomes full savings. So that 0.9% we need to take entirely. It's not reduced to 0.6, it's become 0. Okay. So totally, so I'll just highlight this for you. Okay, so that you know that the difference between recourse and non-recourse is this bad debts reduction, fully reduce. Okay, so you can rather say bad debts reduced to 0%. All right. So your total savings turns out to be $333,000. Now your factor fee was 1.25%. Okay, so is equal to, where it go? 1.25% of the revenue. Revenue is this. Okay, so that will be your factor fee, and factor financing will be 80% of. So since I shifted everything, the formulas have changed. So factor financing will be same actually, because only bad debts is changing. Okay, so factor fee also changes, right? So these are the two changes that takes place, due to which our overall net savings becomes 34,798 dollars. Okay, so we can then they have asked us subsection B. They have asked us which is to be used. Okay, so we can say that uh, given the above information, both the factoring seems to be financially beneficial, as there is a net savings in both options or both types of factoring. Okay, the savings of factoring with recourse is dollar, much was it, 13,498, and the savings, let me just copy paste it. The savings of factoring without recourse is how much? $34,798. Thus, we recommend without recourse factoring as the financial savings is more despite higher factoring fees. Okay, so you can write this FAC, fact, FAC, FACTOR, FACTORING. Okay, so that's your final answer. You can just, let me just text wrap it properly. Okay, so that can be your conclusion. And then they had asked for benefits. We have already discussed the benefits. That is, management can focus on business operation, expertise of the factoring agent, insurance against bad debts in case of non-recourse, factor financing is there, admin costs are reduced, all of that. Okay, so I'll just quickly write it. Just writing the headings, so then you can expand. You shouldn't leave it or do not write 1 point answers, write 2 lines at least. Management can focus on business operations, expertise of the factor agent in credit management, then insurance against bad debts, which is in non-recourse only. Okay, then you have factor financing and admin cost savings. Very important, admin cost savings. You did not hire people for credit management. Okay, so with that, we are done with this question. Let's move on to the next question. Now, before we read, let's go through the requirements. Determine whether ESOP company should lease or buy the new technology. For 10 marks, discuss the difference between nominal term approach and real term approach for calculating the NPV, and discuss how an optimal investment schedule can be formulated when capital is rationed and investment projects are either divisible or non-divisible. Okay. So these two are theory, 5 marks each. This is the calculation part. So let's quickly do our calculation part. So here, so this from the notes, you can just write on this, okay? Write on this nominal terms approach, real term approach. So nominal is basically your discounting rate will be nominal when you have specific inflation rate. Okay, so you are going to inflate each and every cash flow as per their respective specific inflation rate. And then you will have the nominal discounting rate. You can discount it and do it. And when there is a general inflation rate available, what you can do is you can have all the cash flows in real terms, okay, and you can discount it also in real terms, okay, real rate. So that's the real term. This is again in brief. From the notes, you can just formulate your answer. Okay. Discuss how an optimal investment schedule can be formulated when a capital is obtained. So divisible versus non-divisible, it's capital rationing. Okay. So in case of divisible, how are you going to rate the PIs? And in case of non-divisible, how the PIs are going to be ranked. Not PI ranking will be same, but how you can select, because in divisible you can do partial of a project, in non-divisible you can either do 100% of a project or not do anything at all. Okay, so let's start. ASOP companies considering an investment in new technology that will reduce. So the question is mainly, should we lease or buy? Okay, so considering an investment in new technology that will reduce our operating costs through increasing energy efficiency and decreasing pollution. So not only there is also some environmental benefit for this in this new technology. So the new technology will cost $1 million and have a 4-year life, at the end of which it will have a scrap value of $100,000. So we can just write these things down. As we say, our usual cost of machine, our usual summary. So cost of machinery was $1 million. Okay, then we have our useful life. So that was 4 years. Then the scrap, how much was scrap? I forgot. Scrap is $100,000. Okay, this is 4 years. Okay, $100,000. Then what next? A license fee of 104,000 is payable at the end of the first year. The license fee will increase by 4% per annum in each subsequent year. So license fee is paid at the end of the first year. So license fee, okay, is $104,000. I'll just copy this. Oops. Okay, $104,000. It's paid at the end. Sorry, paid the end of each year. Okay. And then they also say that there is a 4%. So it's payable at the end of the first year. So paid at the end the of the first year and each subsequent years. Okay. And the increase in license fee is 4%. Increase in is 4%, which is in each subsequent year. That means that first year it's going to be 104, and after that it's going to increase 4% every year. Okay. The license fee will, yeah. So if ASOP bought the new technology, it would finance the purchase through a 4-year loan, paying interest at an annual before tax rate of 8.6% per year. Okay, so we have our pre-tax cost of loan is equal to 8.6%. That means our post-tax cost of loan will be this into 1 minus T. We always take post-tax for discounting. So our tax is, company tax pays at 30%. So 0.3. That means 6.02%. Okay. Or we can say 6%. Right. Let's see what else do we have. Alternatively, ASOP can lease the new technology. The company would pay for annual lease rental for $380,000 per year, payable in advance in the start of each year. Okay, start of each year. So lease rental is $380,000 paid in advance at the start of each year. Okay, what else? The annual lease rental would include the cost of license fees, so we need not pay a licensing fee separately. So just write that. Okay, ASOP buys a new technology. It can claim tax allowable depreciation on 25%, reducing balance basis, and tax is 30%. So TAD, tax allowable depreciation, is 25% and taxation is paid 30%. Okay, what else? The company arrears. Okay, so 1 year in arrears. Paid 1 year in. Okay, now let us first evaluate EVA. Leasing option. Okay, so years. Now 4 years project. 0. It's 1, 2, 3, 4. Okay. So firstly, what is, if we take it on lease, we just have to pay lease rent. That's it. Okay, so lease rental paid, which already includes license fee. All right, and lease rental is paid in advance at the start of each year. Okay, so for year one, we are paying it today itself. So $380,000. It's an outflow. Okay. And lease rental, well, they haven't said anything about any increase or anything. So it's going to be same. Okay, 1, 2, 3, and 4. So are all 4 years. So fourth year's lease rent is paid in the third year itself. All right. Now, yeah. So in leasing, there is only one cash flow. Okay. We do not take any inflows, because whether you are leasing the asset or you are going to purchase the asset, it's not going to make a difference on your revenue. Okay. So therefore, tax will also not be there, in the sense that tax on profit. So revenue minus cost will give you the profits, and on that you will have to pay taxes. Okay. But only one additional expense comes if you are leasing, that is this. Okay, so since this is an expense which is not considered, okay, you are going to save tax on this. So tax savings on lease rent. Okay, so normally tax will start like this. So previous years, not previous years, but now these are actually paid in advance. Okay, taxes are paid at the end of the year typically. So into 0.3. Okay, it's not negative, it will be a positive figure because it's savings in tax flows. Okay. So this will be tax saving. However, it's happening 1 year in arrears. So 1 year in arrears. Okay. So this is important. This is happening at the beginning of the year. That is, it is happening today. But taxes are paid at the end of the year. So taxes will be calculated year, beginning of year one or the end of year zero. Okay. So then it's 1 year in arrears. So you are shifting it. So this is the main tricky part in this question. Right. So your total cash flows will be okay. Then so that's your total cash flow. Then we can directly do discounting NPV at this thing, or we can find out the discounting factor. Discounting factor at what interest rate? Okay. 4-year loan before inter. Okay, so we already have calculated that post-tax cost is 6%. Okay. So at 6%, or we can just find out the NPV of this. Okay. At 6%, just to save time, is equal to NPV 6%. Now remember, we take only cash flows from year one onwards. Okay, and then adjust for year zero, right? Because year zero is already in present value. Okay. So our total outflow is $1 million, approximately $1 million. Okay. So this is, therefore, we can say that the net present value of outflow in case of leasing is this much. Can mark this. Now we can do evaluating our purchase of the asset. Okay. So let me just copy this only. Evaluating buying options. Okay. If you are buying the asset, what's going to happen? Firstly, there will be uh, initial investment. Okay. Cost. This is initial. Okay. So cost of machinery. Let me just expand this a little. So cost of machinery is $1 million. It's an outflow. Okay, $1 million out. And then this machinery, okay, so you have taken care of the cost of machinery. Useful life is 4 years. Scrap value is $100,000. So scrap at the end of the project, 4-year project, so $100,000 scrap. Okay, what else do we have? License fee is $104,000. So license fee is $104,000 and it is paid at the end of the first year and subsequent years. So $104,000 at the end of first year. But in subsequent years, it's increasing by 4% into 4%. It will be 1 plus 4%. Okay. We won't do raise to 2 or raise to 3 or something because it is increase of 4% from the previous year. So on and so forth. So license fee 1, 2, 3, 4. 4 license fees we have paid. Okay. Now this again is an outflow. All right. And scrap is an inflow. So that will remain as positive. Usually we write scrap at the bottom for tax purpose. Even initial investment we write at the bottom after tax. But here Since we are not calculating taxes on profits, we can consider them on top also as and when the information came. Otherwise, remember in exam first, it should be sales minus variable cost minus fixed cost will give you contributions. Okay, then minus whatever other costs are there. You will get your profits. On profits, you do your taxation. Okay, if 1 year in area, you will shift. Then you will do TAD. Then after that, you will do your cost of machinery, your scrap value, your working capital requirements, all of that. Okay. License fee is done. What else? License fee, increase in license fee, pre-tax cost of loan. Yeah, so these are the only cash flows. Let's just go to the question again. No, there was one TAD. Okay, so tax allowable depreciation is what we need to do. Now, we also have a savings in license fee. So, tax, because that's an expense, right? Tax savings in, okay, LISC, license fees. So, we are saving. What's the tax rate? I forgot 0.3. We are saving. This is not a negative figure, it's a savings, so it will be positive. Okay, but 1 year in arrears. All right, so 1 year in arrears are tax savings on license fee. Now, tax savings on tax allowable depreciation. It's a non-cash expense which we enjoy if we buy the asset. In case of leasing, we do not enjoy depreciation because the owner of the asset will only enjoy it, and we are not the owner in case of leasing. Okay, so very quickly we'll just calculate that. So calculation of tax savings on TAD. Okay, so cost of machine is $1 million. Okay, $1 million. Then we have less tax allowable depreciation at 25%. Okay, and then we have our WDV. All right, we have our tax savings on TAD. So it is 30% of that, and year of tax savings will be second year because 1 year in arrears. One, two, three, and four. So this is third year, fourth year, fifth year. Now keep in mind that for fifth year, actually this won't be there. In fifth year, you are doing less scrap value. Okay, which is $100,000. So this is our balancing allowance. Okay, and on that you will get a tax allowable depreciation, which will reflect in year 5. Okay, so this, 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 this. Okay, these are tax savings, so these will be positive. Okay, so our total cash flow uh, above we wrote CF, so we'll write that's that sum of all of this. Since I've already done the advantage of putting in the value signs over here in the cash flow only would be at the end you can just do sum of everything. You need not do plus minus and everything. Directly get the answer. Okay, and then we can just copy paste this because our formula remains the same. Okay, we'll just see discounting factor 6%, all the future cash flows plus. Okay, so that's 974. Okay, this is actually our working note. Okay, not part of the main answer, but with this we've calculated our T80. All right, so we need to compare more outflow, less outflow. This is in case of buying. Okay, so since the present value of outflow is less in case of buying, we will recommend that. So given the above estimates, we recommend buying the new technology as the present value of outflow is lower. Okay, it's not inflow. Normally we opt for higher NPV projects, but this is outflow is lower than that in case of leasing. Okay, so this can be our final conclusion. Theory questions we already discussed. It was relatively simple, 10 marks. Okay, so section A, I think, was a little more tricky. Section B and C was simpler for the pre-June. And let me see in how many minutes we completed. So within 2 hours, 47 minutes and a 10-minute break we took. Okay, so in 2.5 hours or 2 hours, 40 minutes we completed. Okay, answering the theory questions would take 10 minutes each. So that way you can easily complete the paper in 30 minutes. And here I also took time to reply, which shows that with practice, okay, if you keep practicing more and more and more mocks, you can get these answers simple because you don't have to think. Once you know that a question like this comes, we have to find the NPV. Once you know how to find the which is better factoring as in with recourse, non-recourse, how to solve this type of question. When you know how to solve questions like how to calculate NPV, how to calculate the cost of capital, how to calculate certain working capital ratios. Okay, so the more type C questions you will solve and type B sort of questions you will solve, you will understand that these solvings can become much quicker for you. All right, so all the very best. I hope these 5 days have added value to you and you are in a better position to attempt your FM paper in September. Okay, thank you all for your time. Best wishes. Take care.